to dial in. Roundtable. Today's topic is total return swaps and how investors can use them to boost returns. I'm BJ Belloc. I'm an Executive Director of Nadelma Incorporated. We're a data visualization and business analysis software solutions provider, and I am today's moderator as well. Before we start, I would like to thank our members and especially our sponsors for making these calls possible. Our sponsors, as you can see on the screen, are Bloomberg, Grant Thornton, Alston Bird, Ferential Systems, Baker T, Bank of New Mellon, Deloitte, and New Mountain Capital. And today we're delighted to have John Dukic, founder and president and CEO of Ferential Systems, which provides derivative software trading, processing, and risk management solutions. John is joined today by Robert Dukic, a quantitative analyst at Ferential. And before getting started, some of the questions John and Robert will address today will include: what is a total return swap? What are some of the benefits of total return swaps? What are mechanics and pricing methodology of total return swaps? How are investors using total return swaps to boost returns? What are some of the processing requirements and challenges for firms that use total return swaps as alternative investment vehicles? What are tax consequences? What risks do firms assume when using them? And when should firms avoid using them? And everyone is in listen-only mode, so if you do want to add a question to the list, participants can look to the bottom right-hand corner of their screen under Send To. There's a drop-down. Send your messages or questions directly to Robert Dukic, and he will answer them as they go. I also provide concluding remarks at the end of this call, but for now I will put myself on mute and hand it over to John and Robert. Thank you.
Hi, welcome. I'm John Dukic. I'm the President and CEO of Ferential Systems. Just an idea of kind of our backgrounds. I started out actually as a CPA with Arthur Andersen, and I moved into Irving Trust at the time, which we were involved in the first ones that actually did the first interest rate swap on the market. So I've been in a derivatives market since mid '80s, early '80s, and since then, obviously, the market has expanded quite a bit. I was a trader in the interest rate market world, both for cash products as well as derivative products, and I spent a significant amount of time in the FX world. I spent a lot of time in the quantitative side working with the likes of Pete Karasinski and Derman. And so I spent a lot of time in option modeling, and I started my software business in the mid-90s. And since then I have been working more in the derivative processing, trading, analytics, and risk management. And we get heavily involved in the hedging mechanics of it, and as well as the collateral management side. And we're actually a partner with Nadelma, so we can interface our products with Nadelma's for the business visualization products also. And my son Bobby has joined us a couple of years ago, and he's working on now finishing up his CFA, and is doing a lot of the quantitative analytics for us in terms of the total return swaps, credit default swaps, as well as the intricacies of doing margin calculations, both initial margin and variation margin.
So I'm Robert Dukic, and I guess John gave a good enough introduction for myself. But basically, I help implement any of our quantitative models, including recently the total return swap model. So I guess with that, we can pretty much just jump right into it. The best place to start is really trying to define what a total return swap is, and it's to really start with looking at the cash market and how that works. So in the market, if you want exposure to an asset, you have to purchase it, and that requires a large capital outlay. Further, the asset is recorded on the balance sheet, and And even further than that, the asset may be too illiquid to either purchase, or if you already have it, you may be able to sell it out because it's so liquid. The total return swap kind of remedies those three situations. Being a swap and a derivative, I can replicate the same exposure without having to put up that large amount of capital up front. The derivative is not on the balance sheet, although the P&L will flow through to the income statement. And again, you may be able to skirt the liquidity problems because you can create a contract on any instrument, basically. So what is total return? It encompasses both the price changes of the asset as well as any income derived from it, meaning dividends or coupons. You can specify a published index as your reference, such as the S&P or a bond index. You can specify a single name asset, such as an equity, a single bond, a commodity, a loan, almost anything you can think of. And finally, you can actually also specify a portfolio or a custom index. So, for example, if you have your own portfolio and want to hedge the risk for a certain portion of time, you can enter into a total return swap referencing your portfolio without having to sell and then buy back later on the constituents of your portfolio. On the right-hand side, just kind of a simple diagram of a total return swap. You have two legs. One is the total return receiver, and the other is the total return payer. So you can enter in on either side whether you want long or short exposure. So the total return receiver would obviously receive the total return and then would pay some financing rate, which we will get into a little bit how that's determined later on. In big picture, kind of what a TRS is, that the return on the asset leg will exceed that financing rate. And because it's a swap and the cash flows are netted, you will be left with a cash inflow for every period that that relationship does hold for.
So I would just add in here that, the alternative is you can go buy the bond, right? You can go borrow, say $10 million to borrow that bond. If you're going to borrow in the floating rate LIBOR market, you're going to pay LIBOR. You're going to take that capital and you're going to go buy the bond. End of the time that you want to hold the bond for, you sell the bond, right, and pay off your loan. So the advantage of the total return swap is that you eliminate the need for the initial capital outlays, but the ultimate financing underneath it should be identical to that type of scenario.
So we basically already touched on the return structure of the asset leg. Basically, it's the total return, so the price change plus the income, and you can reference a single asset, index, or portfolio. But the interesting piece comes in on the financing leg. So you either specify a fixed rate, a floating rate, second asset, and the rate is typically quoted as LIBOR plus some spread, which then puts it in sync with the repo market. So basically you're taking two bets with total return swap. One is the obvious bet of the return on the asset itself. The second is a return, the direction of interest rates, basically. So if you think rates are going to go up, you may want to lock in a fixed rate today, or if you think rates are going down, you may want to specify the floating rate for the financing leg. Alternatively, you can specify a second asset as what would be financing leg if you want to do a basis TRS, and you would do that if, say, for example, you had a bond portfolio and you wanted to implement some tactical exposure to equities, for example. You could enter into a return swap where you pay the return on bonds and receive the return on equities, instead of, again, selling out the bonds and buying them back. In return swaps, there are two notional structures. The first is constant notional dollar amount structure. So this is more straightforward. You specify a fixed dollar amount as you would in, like, say, a normal interest rate swap. Each period, some rate of change on the asset is applied to that fixed amount. The complication arises when you are computing the dividend or coupon income. You have to determine the equivalent number of bonds, for example, at each payment period. So because of that, if you're trying to perfectly hedge a position that you actually do have in the cash market, you would just specify the constant unit structure. So what the constant unit structure is basically a fixed number of bonds, for example, that you would specify at the start of the trade, and the price changes would exactly reflect your underlying position, and therefore the total risk would be hedged. But if you're simply trying to gain an exposure, it's a little bit more straightforward to go with the constant notional structure. In terms of valuation, two main methods. The first is the accrual method, which essentially says nothing past today affects the value. You have the change in the price since the last reset date on the asset leg, so basically a change in price up in today, minus the accrued interest on the financing leg, would equal the value for the total return receiver. Alternatively, you can specify the projection method, which would be similar to a normal interest rate swap, where you basically project the cash flows on both legs, and then you discount those cash flows back to today, and then the difference between the value on the receive leg and the payer leg is your market, basically. With the projection method, there may also be a spread in the asset leg if it involves some extra credit risk. So I have to point out, though, that the 2 points on the bottom may not necessarily hold if you're dealing with a risky asset. That's more for risk-free assets, basically. So moving on. Okay, just to compare total swaps to maybe some other products that you are more familiar with or may already use. Again, the assets in the cash market requires large capital outlay, recorded a balance sheet, and again may face some problems with liquidity. Forward and futures, they're a single payment instrument. So with total return, you have an ongoing series of cash flows that match the actual risk of some asset that you're referencing. With forwards and futures, that's not the case. In addition, forwards and futures do not fully account for the income component. You may estimate some dividend yield, for example, when you're pricing the forwards or futures, but if that does not end up being the dividend yield in market in reality going forward, which it likely will not, you're not going to be able to match the exact risk of whatever asset you're trying to reference. So return swaps solve for both of those problems. As far as interest rate swaps and credit default swaps, each of them only hedge one risk factor. So interest rate swaps, you're only hedging LIBOR or any other index that you may reference, or with credit default swaps, you're only hedging credit spread risk. So total return hedges both of those together, basically. In addition, credit default swaps, if using them to hedge a bond, they contain CDS basis risk, which is basically the spread implied from the credit default swap, not be equivalent to the actual spread on the bond that you may be trying to hedge, and therefore the hedge will not be perfect. As far as clearing goes, TRS is not a cleared product. although you may be able to find index TRS on swap execution facilities. Being a non-cleared product, it's probably going to be subject to valuation adjustments or XVA. So based on your own credit worthiness, not the underlying asset, your dealer, for example, may charge you CVA or credit valuation adjustment, and that may, in fact, bump a little bit, not much, the amount of capital that's required to do this trade. So in the cash market, there's a lot of capital. In the swap market, it's not as much, but it's not nothing. So go further, again, since it's non-cleared, it's going to be subject to the bilateral margining agreements, and therefore you need a collateral system to track and potentially project your collateral. You need to make sure that you have enough liquid cash and securities if that's what you're required to post on hand, and you need to make sure that you don't have, any shortage of collateral.
So, I think what I would really cover just a little bit in here, because this has really the high-level topics of the things that you really need to look at when you're comparing which types of products that you want to use. And, to highlight a typical interest rate swap, for example, which is fixed versus floating, has a one factor. It's just whatever the interest rate is on the instrument that you're buying, right? So if it's a 5-year swap, you're buying the 5-year swap rate. When you're looking at base swaps, right, which is now not a fixed rate, it's actually a floating rate for another floating rate, that is more like the TRS, the total return swap, in that I'm receiving one index and paying a different index. So I may choose in the interest rate world to receive, say, the Treasury bill 6 month and pay the 1-month LIBOR rate. And there is on the spread between the T-bill rate and the LIBOR rate, right? You don't want the spread to narrow, you want it to widen, right? And in the total return swap world, right, it's the same thing, except instead of being, say, the T-bill interest rate, you're buying a bond and you're going to receive the difference between the price of the bond. The advantage of it is that you don't have to put up the capital. As Bob was talking, is that it's not that the cost is nothing for the total return swap. The total return swap is actually going to cost you more than the cash instrument would cost, because you have now all of these margin requirements, right? And there's a lot of processing that goes along with it. There's a learning curve that goes along with it also. The prime brokers have to really support the product that you're doing, and you need all the systems in there to be able to handle that, where they would typically be able to handle buying $10 million of an Apple bond. The investor themselves, it's no difference, right? How much do I have to pay in to get an interest in the hedge fund, and whether you're using that cash to buy the bond or enter into a total return swap, right? You wouldn't just go enter into a total return swap without making sure that you have a significant amount of capital to absorb losses that could incur.
The collateral.
Right. And so all of these products have different types of things that they're covering, and they all have to come together so that no one product is worth more than the other. So every one of these you can synthetically create from other instruments, and to arbitrage free, they all have to match. So one of the things we were talking about is, a European option will never be worth more than an American style option. Total return swap will have a way bigger payoff than a credit default swap, because a default swap has a single payment and only upon default and is probability adjusted. So in return swap, you're going to receive the gain or loss on the underlying asset and you're going to pay the financing costs with basically little capital outlay. The disadvantage on the total return swap is that there's way more financial disclosure that has to be made into financial statements regarding the total return swap and your credit exposure, as opposed to having a $10 million asset on your balance sheet of an Apple bond. That's way easier to deal with, right? That if you're looking to hedge, you can hedge accounting treatment by owning the underlying bond and also then selling the total return swap. So if I'm paying off the bond risk, I have effectively reduced my risk exposure, and if you use the proper accounting techniques, you can get hedge accounting treatment for that, such that gain or loss on the total return swap will go matched into the balance sheet with the underlying bond, so you don't get income statement volatility for those that are subject to those accounting rules.
So just to touch on collateral real quick before we move on, what you will be subject to is first variation margin, where it's basically just the current exposure. So if I have a gain on the total return swap for $1 million, my party is going to have to post to me $1 million worth of cash or securities. In addition to that, your dealer may want you to post extra margin on top of the variation margin in due default and stop paying variation margin. In time, the trade itself may not actually be closed, so the dealer is left exposed. And the typical assumption is that it would take 10 days to close the trade. So two ways to cover that. One is independent amount, which comes out of the non-regulatory world, and it's a fixed amount, basically just a % of notional. And really the only thing you have to note about the independent amount is it may be a little bit greater than an equivalent independent amount on an interest rate swap, because total return swaps are relatively more liquid. On the other hand, you have initial margin, which is really the same exact thing. You're never going to do amount and initial margin. It's one of the two. So initial margin came out of the regulatory world, and you're going to basically have one of three models to come up with that initial margin, and it's going to change every day. It's either the historical VAR model, is the standard initial margin model, which is basically also a historical VAR model, but with industry standard calculation, or the grid or schedule model, which is kind of just a fancy fixed amount. If you do end up having a choice between the three, you're probably going to want to go with the SIM because it allows for much less capital to be posted in collateral.
The grid module, which was a regulatory base, is basically a percentage of notional, and it's a very high amount to pay. So if you're paying collateral under the schedules, the amount of collateral that you're posting, the last estimate was maybe between 7 to 10 times the amount that would be under SIM. The next better would be the historical VAR model. I think the SIM model is the easiest, and it covers the worst case scenarios. And to further backtest, you should actually be able to go through and use a historical VAR even internally to make sure that your SIM model actually is really covering it, because you don't want to be exposed and find out that you're not receiving in enough collateral than was necessary in the event that there's a counterparty default.
Finally, we'll move on to how do we actually use these things to our exposure. So first is most obvious. You can take basically a naked position in the underlying. You don't have to go out into the cash market to buy it to gain exposure. Second is diversification. You can equitize your cash, which isn't diversification per se, but it's broadening the scope of your return sources. And into, again, a basis TRS. Again, we had the example before where you have a bond portfolio and you want a tactical exposure to equities for a certain time period. Third is probably the easiest to think of, is just hedging. you want to hedge the total risk of some security. A return swap is really the only clean way to effectively hedge out all of the risk in the security. And again, you would specify the constant units method for the notional calculation. Is deferrals. So you have a capital loss that you don't want to realize. You enter into a total return swap as the total return payer. Lock in those gains so that you don't face additional losses when you end up not having to realize those losses until some future period. Flip side of that, if you have capital gains that you don't want to realize, maybe for triggering capital gains tax, you can do a total return swap, lock in those gains as a total return payer, and therefore not have to realize those gains and pay the tax.
I would want to at least make a statement that, one, you should definitely talk to your internal accountants on the taxability consequences of these trades, and they can vary tremendously across countries. You can have a total return swap on an Apple bond where I have a Canadian investor buying into it, and his tax consequences and tax treatment on the returns of the total return swap will be different than a U.S. investor. And the same goes across, obviously, if you're buying a Euro bond in the U.S. So you need to make sure that you understand the tax consequences of both that. And I've had examples of this where we bought portfolios of bonds, and we've sold off, say, the floating rate bonds to Switzerland, and we bought the U.S. branch bought the fixed rate bonds just for the tax consequences. And so when you look at that, you have to analyze what those consequences are, and they're not consistent. The IRS is not. Let's just say they're not necessarily forthcoming on a lot of these. They've issued some guidance on this, but where you see this a lot is doing total return swaps on municipal bonds. Municipal bonds are tax-free. And IBOR leg is actually a taxable rate, and you have to make sure that you don't bridge the tax-free consequences of the muni bond itself. So in your structuring these, you have to be well aware of what is the index of the underlying instrument that you're on, and what are the tax consequences, trying to get that treated as a single instrument. So if I underwrote a bond and then I sold off part of that risk, right, participants via total return swap, do I have half the position for tax purposes? So can I treat the total return swap as an offset against my underlying cash position, so that I get the same tax consequences for the total return swap as the underlying cash? You definitely want to ensure that you talk to your accountant about it to get some qualifications.
The most interesting method for, let's say, a fund might be leveraged exposure. So in addition to the natural leverage that arises from having to put up less capital in a total return swap, you can leverage it even further by one of two methods. One would be you take a position in the underlying, in the capital market, you enter into a total rate return swap referencing that same underlying, and post the original cash position as collateral. You're going to be subject to a haircut, but that mitigates your collateral requirements and then bumps up your return by how much the notional is in the total return swap. The other method would be simply to put a multiplier on the asset leg. So you could say, I want 2 times the return of S&P for the asset leg. Finally, in any derivatives market, when markets are aligned, there may be arbitrage opportunities. So, for example, you may find that the repo market is not lining up with what's implied on the financing leg, so you'll be able to arbitrage that. Secondly, you may find that the asset leg projection is not what is implied by one of your other models, so you may be able to arbitrage that. And finally, we open up to any questions. If you have a question that you can't think of right now, feel free to email us at sales@ferential.com, and you can visit either of our websites, which are shown there. So we'll open up to any questions now.
Yeah, Bobby, it's BJ again. I have two questions while folks are typing. And remember, if you want to send in a question, address it to Robert in the drop-down here. Type it, and he'll be able to answer it directly. My two questions for you. What other types of firms are involving themselves in these total return swaps outside of the alternative investor space? You know, corporations, international corporations, governments. And the other question is, when should firms, no matter who they are or what they're doing, when should they avoid using these products?
The total return swap itself is actually used in a number of different instances, whether you're trying to, and it's a slightly different whether you're trying to take an equity position versus a bond position. But in the normal scenario where you had a bank, say, underwriting a loan and they want to do a syndication, right? So if I want to do a $1 billion loan, I may want to syndicate that out across a number of different banks. The alternative to doing that is to actually take the entire position on myself and then distributing the risk via a total return swap. Those mechanisms are a little bit easier to document and trade, and so the use of the total return swap on a specific loan or portfolio of loans or an issuance, that is across the market, and you'll see that in the commercial banks. You'll see that the dealers will certainly offer those. Right, as Bob had mentioned earlier, the swap exchange facilities will have, total return swaps listed on specific indices, right? And so you'll see that a lot there. On the total return swap side for the hedge funds, they're great investments in that. It's really the same as buying the underlying position. It's really just a question of how much capital do you want to have to put up in order to enter into those transactions. So the disadvantage may be the type of investor that you're allowed to take on, right? So the more sophisticated products that you trade, then the more closed they are, and you have to be a knowledgeable investor to really be allowed to invest in it, and you have to make it really clear that you can easily make a very big mistake, but that you didn't have to put up the capital that you would normally have to do to take a cash position, yet you've assumed the same exposure if you didn't use a leverage multiplier. Right. So they're great hedging instruments, and they're really good for managing risk without having to get rid of the underlying position. And the other impact where you could use this is that if I put a cash position on my balance sheet, that affects my Basel III and Dodd-Frank rules. So if I depending on where I am with my current balance sheet, the total return swap has less implications on that because it's an off-balance sheet instrument. So the capital requirements that are needed or the capital impact on Basel III is substantially different. The way, if you wanted to hedge it, the other advantage I would say of the total return swap is you don't have to buy the whole instrument. I get a certain period of that, so I don't have to. As a 30-year bond, I can hedge just the risk from 3 to 6 years. This is my forecast of where the yield curve is.
Okay.
Yeah, I would just
further my question would be, what about corporations? For example, Cat Tractor or General Motors are involved, and if so, why?
I would think that they would not be as involved in that, and just from what we see, even in their own hedging activities, is that the expertise is in the business of making iPhones, not necessarily in managing this type of sophisticated risk. The financial services firms, insurance companies, and so forth, absolutely would be very involved in that because they don't want to have to necessarily mess up their portfolio management and the cash flow requirements just to alleviate or manage a change in risk exposure.
That was that also, if you're trying to hedge a bond, for example, the most volatile part of the rates is the short rate, not necessarily the credit spread. So to hedge the bond partially effectively would just do an interest rate swap as opposed to hedging the entire risk, maybe more expensive. That's a negative aspect of total return swaps.
Okay. What about currency components? You know, if you're swapping over different currencies.
The moment you go do a total return swap that is denominated in another currency, obviously you've added yet in another risk factor for that. So you would definitely have to enter into a series of FX contracts to roll that FX exposure. Yeah, what I've seen is that they tend to not do the entire exposure. It's almost just the current leg, and roll it as the payments come, and they'll roll and hedge the next FX exposure.
Period by period?
Yeah, it's a period by period. But certainly once you introduce that risk in there, now you have a whole bunch of factors in there that you need to understand what the consequences are, both from a tax perspective and from just a ordinary income perspective.
Okay, thank you for that, John. Did we have any questions from the audience that did?
It doesn't look like it.
Nothing in the chat.
Yeah, so we actually, there's one question here that is talking about, you know, our total return swaps under the counter product. And that answer is yes, they're actually totally over the counter. There's no exchange traded product that, you know, other than a generic, you know, say a bond option or a bond future, but these are more specific indices or treasury instruments. They're not for a specific instrument. And there's total traded on OTC, so there's no exchange trade market for this stuff. What I was going to add into that is that one of the advantages of having this as an OTC product is that, one, you can customize it exactly to the bond or portfolio bonds that you're trying to offload, right? And you might not be able to short that specific bond size that you're looking. So the total return swap can just be customized. It's just an index. Actually trying to short the bond, you may not be able to get a hold of enough bonds without moving the market, or you just might not be able to get them. So the return swap as an OTC product is actually a very flexible one. And it's a little bit more complicated, so they're still not generic instruments like there are in the interest rate world, where you have a 5-year swap, a 10-year swap, you know, and so forth, where those are just very, very highly liquid. Those instruments are huge in terms of monetary notional amounts compared to the total return swap market. But the total return swaps are still in the trillions. It's not, you know, 80 trillion, but that doesn't, to me, when I look at the notional amounts outstanding in the market, that is not an indication as to, oh my God, that market is huge, because I can add up all of the trades that are sold on the New York Stock Exchange every day for the last 10 years, and it will easily surpass the note outstanding of interest rate swaps. If you look at and condense it down to the actual exposure, it will be in line with the bond market itself. So if you netted that, you know, $500 trillion down, it would probably come down to around 20 trillion. And the market in total return swaps is still less than that, but they're highly customized still, so there's no real market yet at exchange traded product.
I would add also, there's been somewhat of a push to come up with this product called total return futures. are only on indices at the moment, and I'm not exactly sure how well they've been received. It's basically a push to the exchange-traded world, although they likely won't be as well adopted as total return swaps because of the lack of customization.
Okay. Thank you for that. Are there any more questions that have come in?
Actually, there's a question on return swaps and how they're expected to behave with respect to Brexit. That's a really hard one to tell because just what the impact is on Brexit itself is not known. I actually had a very interesting conversation last week with a member from London, and I don't think that they have down the real mechanics of it and what the benefit of Brexit is going to be, and it's so diverse that the people that are against it, think that the cost is going to so far outweigh what the benefit of staying in the European Union is, and there are a lot of others that think that it's actually going to be a net benefit because of the cost of supporting the countries that are not basically Germany and France. They're better off, and they'll actually have better credit and better effect on the pound exchange rate once they get out. So you can look at where the exchange rates have been, and they're nowhere near where they were a couple of years ago, right? So 1.10, 1.1 on the euro, and I think the pound is 1.3 now. I mean, it's nothing compared to maybe the historical average, which is more up in the 1.65, 2.0. So it's really a little bit hard to tell where that is going to be and what that impact is going to be, but that certainly has a lot. It's going to have a very big impact, and it's not sure really which way that's going to go.
Okay. Any more questions?
So the other was there's one question regarding what the impact is on LIBOR, the new indices, and I anticipate that there should be anything significant to those other than basically re-agreeing to what the underlying index is going to be paid on. This is kind of still fun with numbers, right? So no matter how you go and calculate the numbers and calculate the financing costs, the target market is still moving towards an overnight collateralized rate, right? And I think, as Bobby kind of alluded to earlier, that there's the margin requirements and on both initial margin and variation margin, to me, support not the LIBOR, but a SOFR index or some overnight swap index, because that's what your exposure is. That's really where the funding costs are. So with that, whether or not your prime broker is charging a CVA, or the deal is charging you a CVA adjustment, and you're also posting initial margin, right? That you definitely want to analyze those costs and make sure that they're not overcharging you.
I think that's it for the questions. So at this point, I would like to thank John and Robert on behalf of the New York Alternative Investment Roundtable. Very informative discussion. As John marked, their contact information is up on the screen. And so everyone's aware, we will be posting the audio for this call on our website. So if you want to re-listen or recommend it to others, feel free. And the PowerPoint presentation as well will be posted to our website. And with that, we again thank you, John and Robert. Stay tuned to our website for the details on our February monthly call. And I would like to also thank again sponsors and our listeners today, and wish everybody a great rest of the week. And with that, we'll conclude the call. Thank you.
Thank you very much.
Thank you.
All right.